This is the Kevin Simpson Show, expert insight and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Hi, my name is Kevin Simpson. I'm the founder of Capital Wealth Planning, and this is the Kevin Simpson Show. My co-host today is Jay Coulter, and we're thrilled to have you.
Yeah, Kevin, I'm excited for this project. The Kevin Simpson Show, I think, is going to offer a unique format. So Kevin's going to invite a guest on. I'm going to formulate a set of questions for the guest and Kevin. Kevin and the guest won't know them in advance, and it will be a lively discussion about what's going on in the markets and the economy. Let's get started. Kevin, you want to introduce your first guest?
Well, I want to just say that this is the best format for a podcast, and I would encourage others to try it because it really seems like Jeff and I don't have to do any work. We just sit here and answer questions. So well done, Jay. We're thrilled to have my very, very good friend, mentor, teacher, partner, Jeff Saut, joining us today. Jeff has an esteemed career that goes back many, many decades. He's been writing strategy for over 50 years, as a follower of Dow theory, which we employ in our strategies. He is a great friend and someone I learn from. So when we think about the very first broadcast, there's no one else I would want to be our first guest than my good friend, Jeff Saut.
You're too kind.
Jeff, you're a very well-known commentator on the markets and the economy. Viewers and listeners, I encourage you to visit sautstrategy.com and sign up for his newsletter. I'm a big fan. Jeff, let's get started. At the beginning of the year, you said that we were in a secular bull market, on CNBC. We're recording this in the middle of February. Do you still feel that we're in the middle of a secular bull market?
We have been in a secular bull market since March of 2009. Actually, the majority of stocks bottomed in October of 08. 92.6% of stocks traded bottomed in 08. But the averages kept going lower because the financials were weak, and they kept going down into the March of 09 low. But since that low in March of 09, we have been in a secular bull market. And secular bull markets tend to last 15 to 20 years. And there's no really time limit on it. I mean, they can last 30 years. So these people that every time the market turns down say, we started a bear market. I don't see what they're looking at to reinforce their bearish case. I mean, just last week, all the advanced decline lines that I follow, which is about a half a dozen, made new all-time highs. And the participation in there, I mean, if you look at the cash on the sidelines, the average, I shouldn't call them average, the individual investors are scared to death. They don't believe it, and they're underinvested. And before this secular bull market is over, they will be fully invested.
Yeah. So, Kevin, you and I both do a lot of work with financial advisors. What's your take and what advice are you giving financial advisors about where we are in the bull market?
Well, we agree with Jeff. We think we're in a bull market until we're proven otherwise. That doesn't mean, and Jeff will give and provide great market history on some of the pullbacks that we've had during a secular bull market, and some of them have been rather severe and steep. So volatility is normal. We're all looking and focused so much on the vaccine, the COVID-19, the reopening of the economy. Seeing continued volatility here in the first half of the year is a normal expectation, but the second half of the year, I don't think you can help but be enthusiastic if we're heading back to normal and we're able to go to sporting events and movie theaters and theme parks and get together in more socially normal ways. The consumer could be explosive in terms of what this economy could do and how they could spend. So we're incredibly enthusiastic on the second half of the year.
Well, Kevin, let me follow up on that. This morning, the jobless claims print came in pretty high, 861 versus an estimate of 773. How do you juxtapose that and some other negative information data we might be receiving now with your longer-term outlook?
Well, we haven't reopened the economy yet, so the numbers shouldn't come as a surprise, especially when you're looking at winter months. It's a much different world when we're stuck inside and versus a summer month where we can be outside. So I don't think those numbers came as a surprise to Jeff or myself. But when we look at what the spring holds and what the summer holds, I think that'll tell the real tale.
Excellent. Jeff, what's your take on the print this morning?
The numbers I look at are impressive. I mean, the economic numbers are coming in stronger than expected. The economy's strong. The consumer does have pent-up demand. I agree with Kevin that that pent-up demand will likely be released in the second half of this year. I think the economy is going to surprise everybody on the upside, and I think the stock market is going to surprise everybody on the upside. And I think investors should be, well, I'm never 100% invested. I always have some cash, because if one of the portfolio managers I talk to comes up with a good idea, I don't want to have to sell, Raymond James stock to raise cash to buy the new idea. In fact, I just talked to Amy Zhang this week, who runs the Alger Small Cap Fund, and was up 42% last year.
So a big problem that financial advisors have is allocating new money today. And so without giving specific recommendations, tell me about, Jeff, how advisors should look at new money from a philosophical perspective. $1 million in new money comes in. How do you start allocating it today?
I think you break it into 4 tranches of $250,000, and you commit the first tranche, this week or next week, but you commit it. Because if you sit back and try and wait for an exact timing point, investors, to a large degree, will never commit the money. And then you step back and you wait and see what the market does, and somewhere down the road you commit the next tranche, and then the next tranche, and then the next tranche. But I think that's the way to do it. And regrettably, not that many financial advisors do it that way.
Kevin, I know you work very closely with the advisors that are working with your firm. How do you advise them to approach new money from a philosophical perspective?
Well, I agree with Jeff. I think dollar cost averaging is a time-tested technique that never goes out of style. Murphy's Law tends to surround the investor that puts everything to work day one. Markets have been on a tear since last March. So we think that if you're able to allocate over a definitive period of time and take advantage of the volatility and dollar cost average in, that you're going to give yourself the best chance of success. I've never met a market timer that's been right often.
Kevin, you've been on my show several times, and that is a reoccurring theme. Dollar cost averaging really does work. So, Jeff, in your latest newsletter, you put out some thoughts around inflation and the 10-year. Tell us, what are you thinking today as it relates to how advisors should approach the 10-year?
Well, I was on a conference call with friends of mine at Putnam, 3 portfolio managers that run the DIT fund for them, which is a kind of unique bond fund. In fact, it's the only fixed income investment I own, and I've owned it for over 10 years. And the discussion I had with them, it was about a 40-minute call. We decided that as long as the employment situation is a little sketchy, that we don't need to worry about inflation. And if we don't need to worry about inflation, we don't need to worry about interest rates going up dramatically. And amid that backdrop, and given what earnings are doing in the equity markets, stocks are going to travel higher. And I don't see anything, unless there's a geopolitical event that comes in out of the blue, that's going to stop the equity markets from going substantially higher. And regrettably, very few people believe it, other than Kevin and I.
Tom Lee.
That is true. Kevin, what's your take?
Yeah, I think with Jeff's point, if you have historically low interest rates that are going to be under pressure by the Fed to keep them low for the foreseeable future, that it bodes well for the markets. And to hear Jeff talk about the secular bull market and being enthusiastic about things, it's not uncommon for him to get laughed at. I remember in late March of last year, he was on CNBC on Squawk Box, and everyone looked at him like he had 2 heads. But the call was spot on. And to their credit, they did have Jeff back on a few months later, and it was almost an apology, maybe not quite, but definitely an acknowledgement of how Dow theory works and looking at markets. So if there's this money on the sideline and it's somewhere in excess of $4 trillion, to Jeff's point, when that money enters the stock market, that's the time for us to rethink where the market's headed.
That's a great that's a great segue. Jeff, I know that you have spoken about Dow theory and its implications in your thought process for probably 5 decades now. Could you tell folks that are new to your work how you use Dow theory in formulating your thought processes?
Well, it's not my theory. It was posited by Charles Dow decades ago, and it's not real complicated. It is subject to interpretation. And it basically is the interrelationship between the Dow Jones Industrial Average and the Dow Jones Transportation Average. When they make simultaneous highs, that's a Dow theory buy signal. When they make simultaneous lows, that's a Dow theory sell signal. And it doesn't have to be on the same day. It can be a week apart. It can be a month apart from making new highs or new lows and confirming with one or the other indices. I will say that the shorter time frame that the averages confirm the other average, the stronger the signal. I would also say that Dow theory also comes in conjunction with values. You know, how cheap is the equity markets? What are the earnings projections? So, you know, this isn't a science. There's no black box. This is more of an art form and subject to interpretation. And the longer you're in this business and the more cycles you see, hopefully the better you get at interpreting the signals and making correct calls on the market. I will tell you this, the big secret for the successful investor is having the ability to limit their losses. And not many people have that ability.
Jeff, you at Capital Wealth Planning, do you guys leverage Dow theory, or what types of constructs do you use when you're particularly looking at your covered call strategies?
I'll leave that to Kevin.
Well, we love Jeff's research. We've used it long before we've aligned with one another. When he was the chief investment strategist at Raymond James, we were utilizing Jeff's work, and fortunately, we became friends and get a little bit more direct access to the man behind the curtain these days. But in terms of the allocation of the portfolio at Capital Wealth Planning, everything is strictly rules based. So the broader market calls are going to have less of an impact on our portfolio because we're mandated to try to be 100% or close to 100% invested in the stock market. To the extent that we have cash in there, usually it's going to range somewhere between 3 to 6%. It's been a little bit on the higher side, honestly, since last March, not for any market timing reason, but we've hovered around 10% cash because as we invest things, we've seen some positions getting called away. So really a little bit closer to 90% invested over the past year. But the idea of covered call writing, to Jeff's point, is thinking about how can we manage the downside? How can we manage and harvest volatility? How can we protect our investors from participating in all of the downside? And utilizing a covered call approach can help modestly protect some of that downside. You're forfeiting a little bit of the potential upside, and for us, that's fine. It's our objective to participate in up markets, and if we can capture 80 to 90% of an up market, well, we feel that's a great win. Because far more important to us than capturing or beating the up part of the market is to be able to protect those down cycles and those volatile environments where if we can limit our clients' exposure to the downside, then we really feel like we're doing our job as a good steward and a good money manager.
Excellent. Final question, and I would be remiss as an interviewer if I didn't ask you guys about your thoughts around Bitcoin. Today it crossed over $52,000. And I'd like to yet answer the question through this lens. How should financial advisors approach the whole cryptocurrency space and Bitcoin in particular? Jeff, we'll start with you.
They should ignore it.
And why is that?
It's unanalyzable. I've seen these things with the CB radio craze when they put in the 55-mile-an-hour speed limit back in I guess that was the 70s. I've seen it time and time again where you get into these crazes. The internet craze in the late 1990s and early 2000s. The stocks separate themselves from reality, and I don't play them. You know.
Excellent. Kevin, what are your thoughts around Bitcoin and how financial advisors should look at them for their clients' portfolios?
Well, Jeff was also around for the tulip craze. I'm surprised he didn't reference that. I can tell you that it's not in our world. We invest in high quality blue chip dividend paying stocks. So Bitcoin's about as far away from that as you can get. But recognizing that there's an emerging potential for an asset class there, the fact that you're seeing larger institutions acknowledging it, I think that it would be a mistake to ignore it, to Jeff's point, but I don't know that we would want to make it a large part of any allocation. It's certainly not going to be part of our portfolio, but the idea of having a small sleeve for certain speculative things, I don't know that that's inappropriate. And the fact that they now have it as part of the CNBC ticker on their website, I think gives it tremendous validity that it hasn't had previously. But if a financial advisor was to put a 1% to 3% sleeve into some type of cryptocurrency as a speculative inclusion in a portfolio, I can't comment on it. I don't understand it. I don't know about it. We need millennials to explain it to Jeff and I. But having a small allocation to something speculative is never a silly idea.
Excellent. I noticed that ticker just the other day that it was on there, and I thought that's either the top or it's come of age. Who knows which way it's going? Gentlemen, I appreciate you guys coming on the first ever Kevin Simpson Show.
Thanks for having us. Thanks for hosting us. And with this format, we can do these 8 times a day.
It's a pleasure.
Thanks, Jeff. Thanks, Jay. We'll see you next time on the Kevin Simpson Show.